Holy smokes, everyone. House prices just crashed 35% in this one city. But first, what you need to know is the US housing market isn't just one market. There is markets in markets. While I'll be going over this area and why this city is crashing 35%, you may be in an area where prices are still rising. But what I'm expecting is the declines we're seeing in this city, we're about to see it flow into much more cities and it's coming to a town near you. Because yes, while the housing market has been more resilient in general than I thought, we're about to have much more pain coming with interest rates going to go much higher than anyone believes. So everyone, what city is crashing so much? What new housing data have we got to show us that things are getting worse? Well, that's exactly what we're going to go over in today's video. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Well, could have you guessed it, everybody? Look at this. San Francisco Bay Area housing market crashes and prices have plunged 35% from crazy peak. So that's absolutely crazy, everyone. In the San Francisco Bay Area, which I'm sure it's no surprise to anyone because the price was so unaffordable, we're really seeing San Francisco really deteriorate with the crime and with the state of the homelessness crisis in the area. But this is shocking that prices have crashed 35% in just 10 months. Listen to this. There better be a halfway decent spring selling season, which is supposed to have already started in San Francisco and Silicon Valley, because this is getting pretty bad pretty fast. But it's hard to imagine just how good the spring selling season can be amid countless reports of layoffs, working from home somewhere else, with big numbers being thrown around about how many people have left Silicon Valley in San Francisco. The city of San Francisco alone lost 56,000 residents, or about 6.3% of its population, in a period of 2020 through to 2022. So the city of San Francisco has lost 56,000 residents, and on top of this has been 12,000 new units completed. So let's hit the charts, everyone. So look at this chart here. The median price in 9-county Bay Area plunged by another 8% in January from December. That's right, 8% in just 1 month, people. That's absolutely insane. By 17% year over year and 35% or 540,000 in 10 months from the crazy peak in March 2022. That's from 1.54 million to 1 million, according to the California Association of Realtors. And sales of single family homes in this area have plunged 37% since January year over year. Now, just to put this in context and get a good comparison, let's see how fast and how much house prices crashed in this area in 2007. So another chart here, everyone. During the housing bust 1, that's the 2008 subprime mortgage crisis, which started in the Bay Area in mid-2007, the median price plunged by 59% in 21 months from May 2007, where it was 789,000, through February 2009, where it dropped all the way down to 321,000. So I don't know about you, but I think 312,000 sounds a lot more affordable than the 1 million or 1.5 million it was during the peak in 2022. So during the first 10 months of the 2008 subprime mortgage crisis, the median price plunged by only 23% compared to 35% what we're seeing now. So that's right, everyone. In this area, house prices are crashing 50% faster than they did in 2008. I know what you're thinking, well, they've been calling for a housing market crash forever. Nothing has happened, and that's because we haven't hit peak interest rates yet. And the housing market is very slow to react. People are holding onto their properties a lot longer because they can't afford high interest rates. So we're not going to start to see real price declines fall until inventory picks up. Now, again, people aren't going to just sell their house because they can't afford the high interest rates. So we won't really see inventory pick up until we see either people get squeezed from the cost of living crisis, from inflation, from credit card debt. They may have no choice but to sell the home, or 2, we start to see the unemployment rate tick up and we start to see more mass layoffs, leaving people with no choice but to sell. Because look at this, everyone, there's not much demand at all. US home sales post 12 straight month decline as house price inflation cools. This report is actually much worse than people thought. So US existing home sales dropped to the lowest level in more than 12 years in January, but the pace of decline slowed, raising cautious optimism that the housing market slump could be close to reaching a bottom. Well, people, I don't know about you, but I don't think we're anywhere close to a bottom. Maybe, yes, home sales may pick up when more inventory comes onto the market in the spring selling season. But again, with more inventory, with there being no demand, with house prices still being so unaffordable, and now mortgage repayments or interest rates have more than doubled, there's just simply no way these house prices make sense. Homeowners can't afford it, and the yield on these investment properties don't make sense at all. You can literally put your money in the bank and get a better yield than you can with the rental yield on these investment properties right now. Because look at this, we have had a cooling in the market because interest rates have fallen from 7.24% on the 30-year fixed rate mortgage, I could say. But now we're starting to see an inflection point. We're starting to see mortgage rates tick back up again and are now hit 3.77%. And I actually do think we're going to beat the 7.24% yield we saw, the 30-year fixed rate mortgage we saw in November. And I think we could be hitting 8% mortgage rates very, very soon. Now, something that could save the housing market and the stock market, etc., and something I've been talking about and something I've been very, very worried about is if the Federal Reserve changes its inflation target from 2% to 4%. Now, a lot of people are saying, no, it won't happen. I don't think it will happen. But we're starting to see more and more calls for this now by famed economists and famed investors. Look at this. So Fed can't reach 2% inflation goal without crushing economy, Al Iran says. He says the stable inflation rate should actually be 3 or 4%. Now, maybe if the CPI was actually accurate on recording inflation, maybe okay, you could try to say, okay, 3 or 4% is not too bad, we can handle it. But unfortunately, the CPI massively underreports real inflation. And you know all these periods when they just said, oh, we only had 2% inflation from the periods of, say, for example, 2010 to 2022? Well, no, if you actually look at shadow stats, we had much higher inflation than they said when they were hitting their 2% inflation goal. Look at this around. This is a chart of the way they used to record inflation based on the 80s model. And we can see here during the 2010s, we actually had periods where inflation went over 10%, and even when we hit the lows, it was still around 7%. Much higher than the 2% Federal Reserve goal. So if the Federal Reserve changes their inflation target to 4%, you better believe we'll be having real inflation rates more like 10%. So he was calling the Fed too data dependent, and he said the supply side developments, including an energy transition, the change in supply chains during the pandemic, and a tight labor market, and shifting geopolitical issues necessitates the higher inflation target. Well, I don't think it means we have to have a higher inflation target, but I do agree with him here. This means inflation is going to be higher for longer, much longer than the economists and the markets anticipate. He says here you can't change an inflation target when you've missed it in such a big way. He's previously cautioned that changing the inflation target could hit the Fed's credibility. Yes, that's right, but he's starting to panic now. I think his bond investments are not going good at all. When asked on Friday if the Fed could tolerate higher inflation, he said, "This is where I hope to go. Yes, this will be good for the market, the housing market, stock market, cryptos, etc. Even gold and silver will be very, very good. But what it will lead to is the death of the middle class. We've already been seeing the standard of living for the middle class has been plummeting lower and lower. The rich been getting richer, the poor has been getting poorer. It's because inflation benefits the rich. The rich hold a lot of assets. Their cost of living is relatively low. Most of their income goes to spending on their business or spending on assets. Cost of food, transportation, housing is very, very low for them. And they can cut back. They can cut back massively. If they've got a mansion, they could sell their mansion and move into an apartment. But for the middle class and for the poor, even, one bedroom apartment now in New York City is $2,000 to $3,000. So they simply can't cut back. Food costs are skyrocketing, and simply they need to eat. They can't cut back on that. Energy costs are skyrocketing. They need to stay warm in the winter, so they can't make cutbacks. But the rich, when inflation gets bad, they can cut back. They can cut back massively, and their investment portfolios absolutely skyrocket. So guess what will be good for the markets if the Federal Reserve does this? This would be the end of the middle class. And ultimately, what I think would mean is we'd have to actually have even higher interest rates if they tried this, because inflation would become unanchored and we'd start to see inflation go into the double digits, and we could even risk hyperinflation. So I really doubt the Federal Reserve will do this, but this is a risk we all have to pay attention to, and we have to watch what the Federal Reserve says, because they speak in riddles. They won't go outright and say, yes, we're going to change our inflation goal, but they will give little hints if they start to do it, and you have to pay very, very close attention to their language during their press conferences. But everyone, I know what you're thinking, well, okay, what does all this mean for you in simple terms? Well, what this means is in the Bay Area, house prices are crashing and crashing massively. I expect this is going to start to spread to more and more cities, especially cities like Phoenix, Texas, etc. that saw massive price spikes during the pandemic. We still haven't even hit peak interest rates yet, so we're going to start to see more pain in the housing market, but we really won't see a real crash in the housing market until we see the unemployment rate tick up and people are forced to sell their home once they lose the income. We've been seeing the unemployment rates very, very low. People can't afford to get a higher mortgage rate at another home. That's why they're not selling. That's why inventory is remaining still fairly low. But once unemployment rates start to tick up, people have no choice but to sell. But everyone, what do you think about this? What do you think will happen to the housing market this year? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.